Hello, 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 and welcome to another episode of Freedom Ain't Free. Would you like to know the top 401k secrets? The wisdom, the knowledge, and the understanding of how to use this powerful tool to get you to financial freedom. We're going to talk today about how to pick the mutual funds inside of your 401k. I have these conversations with my clients all the time. Most Henrys, high earners, not rich yet, have the bulk of their assets are in their investable assets are in their 401k. But the questions I typically ask them is, how did you come up with this investing strategy, right? Why did you pick these funds? Why did you pick this order? Why do you have this amount in this fund versus this amount in this fund? And you want to know the typical answer I get from them? I have no idea is the answer that I typically get. We're simply sitting out here throwing up our financial future mud up against the wall and praying that the strategy that we put together is going to get us to success. I want to encourage you on today. If you haven't already done it, in the description below is a link to get your freedom number. Click on that button, get your freedom number, find out exactly how much money you need to save on a monthly basis to get you to financial freedom. We define financial freedom here at the Freedom Ain't Free channel from an income perspective. You need $120,000 to $160,000 a year coming in from your assets in order for you to get to financial freedom. In order for you to do that, you need to build out a portfolio of at least $2 million. We're going to teach you. We're going to show you how to do it. Today, we're going to talk about how to analyze the mutual funds inside of your 401k. And I'm going to give you the 4 things that I want you to look at as you're making a decision of where you're going to invest your greatest piece of your puzzle. Why do I encourage people to invest in 401k? So first and foremost, I'm from an era where free money was a good thing, right? So I don't know what these other gurus are running around talking about, right? If somebody's going to give me some free money, I'm going to take it. The only place in America that I know of that you can get free money investing is inside of a 401k with a match. Now, if your 401k doesn't match, that's a different conversation, and that's a different strategy possibly. But if your employer is going to give you $1 for every dollar that you put inside of this strategy, I'm telling you right now, collect all the dollars that you can, right? Yes, we're going to have to pay taxes on them. Yes, they're going to require us to pull the money. All of those other things. Doesn't matter. Free money is free money, and you better get all the free money that you can. Now, because you've already doubled your money, you put in $1. Your employer gave you $1. That is a 100% return on your investment. Now, from there, you're going to take those $2 and you're going to go put them into stocks, bonds, or mutual funds, depending on what the offering options are within your 401k. So I'm going to give you 4 strategies to look at when you're analyzing mutual funds so you can make a determination of where you want to invest your money. Now, these are my top secrets, ladies and gentlemen. I charge thousands of dollars a year to walk people through this process. But today, I'm going to give you my secret formula for analyzing mutual funds at no charge and no cost to you. In addition to that, in the link in the description of this video, I'm going to give you your freedom number, the exact amount of money that you need to save and invest, right? Which, if you include your match from your 401k, reduces the amount. But the exact amount of money you're going to save and invest in order for you to build out this $2 million portfolio. Okay, so here we go. Let's go on this journey. Step number 1. You want to analyze the performance of the mutual fund, right? And you want to look at mutual funds that have been around for at least 10 years. The other number that you're going to see is a number that's called since inception, right? So that means as long as this particular fund has been in existence inside of your 401k. The fund may have been in existence longer than that, but your employer may have only allowed you or the company the option within a smaller window. So we want to analyze either the 10-year number or the since inception number. That's going to tell you what the performance of this fund is through good markets, bad markets, right? Through the highs and the lows, all of those pieces of the puzzle, good economies, bad economies, right? I want to see how well this fund performs overall, not in any good one year, okay? So you want to take a look at the 10-year number or the since inception number. So this is what you do. Sign into your 401k. Click on the performance button scroll down and you should have a list of all the fund options that you have. They're going to give you a 1-year return. They're going to give you a year-to-date return, a 1-year return, a 3-year return, a 5-year return, and then they're going to give you a 10-year or since inception return. And that's where you want to focus your attention on. If the mutual fund has been in existence for less than 10 years, then you're not going to be able to get a full analysis of what its opportunities are or what its challenges are. It just hasn't been around long enough for that determination. The last 10 years have been relatively good in the market for the most part. And so if you're looking at a fund that's only been around for 2 or 3 years, then it hadn't been around long enough for you to use this particular formula. I like funds that have been around for at least 10 years, and I can get a good idea of where this thing is going to go in the future. Now, I can't predict the future. You can't predict the future. Any investment advisor that tells you they can, you should run for the hills, right? We have no idea what the market's going to do. We can only look back at the history of a fund and determine whether or not we think it's going to stay on that trajectory or not. So once you determine the 10-year number or the since inception number, I want you to apply the rule of 72. The rule of 72 tells you how long it's going to take for your money to double. So you take 72 in your calculator, put 72. Divide by the rate of return, and that's going to tell you how long it's going to take for your money to double. As an example, if you were getting a 1% return on your investment, 72 divided by 1 says it's going to take 72 years for your money to double. And I don't know about you, I'm not trying to work 72 years. If you can get a 10% return on your money, 72 divided by 10 says your money should double every 7.2 years. Now we're talking, right? And so when you're looking at how long do I want to work? How many doubling periods do I have between now and the time that I want to live off my assets, right? So we want to encourage you to do the math, right? And then that's going to help you to determine which of these funds you should probably put your money in. Now, every fund is going to have some risk. You got to analyze the risk within the fund to understand whether or not you're comfortable to get that rate of return. Means you're going to have to take on the risk that goes along with it. So step number 2, analyze the top 10 holdings. Most mutual funds are going to invest in hundreds, if not thousands of companies. But you're going to find that the bulk of the money in the fund is in top 10 holdings, right? So that means these 10 companies is where this particular fund has most of the money, okay? And so when you analyze those, you can look at that list and determine, have you ever even heard of these companies? Right? Do you know what they do? Do you know what they sell? What industries are they in? Is that a good industry? Is it a dying industry, right? So before you go and put all of your money into an industry or into business or into a sector, you probably should understand what that business and that sector is. So your top 10 holdings. What I find is a lot of my clients have money in this fund, money in this fund, money in this fund, money in this fund. And they look at me and they say, hey, Joe, I'm diversified. I have my money in 4 or 5 different funds. No, you're not. If you look at the top 10 holdings of those 4 or 5 funds, you're going to find out that you pretty much have all your money in the exact same companies. You just have them in different mutual funds with different names. But underneath that, your money is going to the exact same top 10 companies. So you really need to look at the top 10 holdings and make a real determination of some of my money might be here, some of my money might be there, right? So we want to encourage you, dig into that. The third one is fees. Now, you're not going to hear anything bad about fees coming out of my mouth because I believe in advice, right? But I believe in paying for advice to get better results, right? Not just paying for advice. So when you look at a mutual fund, it's going to tell you how much you got to pay the fund manager for doing their work. Well, if you're not going to beat the S&P 500 index, then I don't want to pay you, right? Because I can just put my money in the S&P 500 index, which is going to typically be the lowest fee option in your 401k. So you want to reduce your fees. That's going to increase your profit. So I don't mind paying a little bit more of a fee if I'm going to get better performance than I could get in the S&P 500 index. So you want to analyze the fee when you're looking at the holdings. And then the last thing you're going to want to spend time focusing your attention on is the management. Who's running this fund? I like to analyze that because if you look at the results of the fund, but this particular fund manager hadn't been there, those aren't his results. So you looked at this fund that's been around for 20 years, but the dude who's currently running the fund has only been there for 2, right? So that 20-year number you're looking at is not his report card. The example I use with my clients all the time is, if you look at the New England Patriots and you say the New England Patriots have won the Super Bowl, 6 times, right? Well, the current quarterback of the New England Patriots haven't won a Super Bowl yet. So those 6 rings that belong to the team don't belong to the current person running the team, right? So you got to make sure that you take a look at the management, who's running the fund, how long have they been there, and what is their track record, because that is what your future is going to be based upon. So I want you to get the wisdom, the knowledge, and the understanding of how all these tools work. So in order for us to do that, step number 1 is we got to get your freedom number. You need to know the exact amount of money that you need to save so you can live off your $2 million portfolio, live off your assets, not live off your labor. Click in the link below. You can get your freedom number today for free. And what I want you to understand about that, after you get your freedom number, right, then you got to activate that and put those pieces in these principles together. And so we want to encourage you to take a look at all of the steps and all of the processes and all of the videos that are going to help you accomplish that. Because remember, freedom ain't free.